Good afternoon, everyone. This is Barb Armstrong coming to you live from Salt Lake City. I'm just getting my captioner refreshed here. So happy to have you joining us this afternoon. Today is Friday, December 14th. My name is Barbara Armstrong, and we have half an hour together this afternoon to talk getting started with options. So we do this class in about a 10-week rotation, and we are back to the very beginning of the rotation again. And so today we are going to talk about some of the basics, and then we're going to go out to the Thinkorswim platform and place a trade. So let's get through our important disclosures so that we can get right down to business. So the goal today is that whether you are someone who is brand spanking new to the world of options, or you are someone who has dabbled in options before but is just getting kind of back into it again, or perhaps a seasoned veteran, this can be a good review for each and every person. And the goal is at the end of the class today for you to have a good idea of what a put is, what a call is, and when you might want to buy or sell either one. Okay. Getting down to business. Options are not suitable for all investors, as there are special risks inherent to options trading that can expose investors to potentially rapid and substantial losses. You might want to get a copy of the characteristics and risks of standardized options and have a look through that. We're not going to do multi-leg option strategies today, but when we do, know that those can have more substantial transaction costs. We aren't going to look at a weekly option today either, but know that with weekly options, because they are shorter lived and often less robustly traded than the monthlies, they can be subject to more significant volatility. Also, if you're doing a trade that has a minimum potential benefit, that can be more significantly impacted by transaction costs. We are not going to talk about futures today. In order to demonstrate the functionality of the platform, we do use actual symbols, and we will definitely be doing that, but that is not to be construed as a recommendation on the part of TD Ameritrade or myself. We cannot begin to determine the suitability of any security or strategy for an individual trader. Any investment decision you make in your self-directed account is solely your responsibility. And the paperMoney platform on Thinkorswim, which is a phenomenal way to hone your trading skills and learn how to use the platform. Just because you trade on it successfully in one period of time doesn't mean that when you go to your live account, because the markets keep changing, that you're going to get the same results. Please understand that all investing involves risk, including the risk of loss. Okay, so now that we're through all of that, what next? Okay. What we're going to do is close these down and come to a blank screen. Isn't that fun? Well, the reason I'm doing this is because I think it's so important to really have a good idea in your mind of what it means when you are buying or selling a call or a put. And really, options, two types of options. There's puts and there's calls, and you can only do one of two things with a put. You can buy it or sell it, and you can buy or sell a call. That's it. But we can put them together in lots of different iterations, but it's important at the beginning to just understand what it means when you're buying a put or buying a call, or what it means when you're selling them, and what your intentions are, and how much you can make or lose. So we're going to do something that I affectionately call the 4 grids. So we're just going to draw. And the reason I'm doing this by what I call natural master is because I think if you're new and you really want to understand options, that this is something you can do if you're waiting to pick your kids up somewhere, or waiting to meet a friend. You can grab a napkin or an envelope and draw on it on the back of your counter, and just, blow through this pretty quickly, but it'll just reinforce for you what it means when you buy a call or a put, or you sell a call or a put. Okay, are you with me? If you have any questions as we go along, please don't hesitate to ask. So when I buy a call, what does that mean? Well, when I buy a call, it gives me the right, but not the obligation, to buy the stock or the underlying at the strike that I've purchased at any time up until expiration. So it means I've got the right to buy. When I buy a put, it actually is in some ways the opposite. It gives me the right to sell. I know this isn't the sexiest of handwriting, guys, so it gives me the right to sell. Now, what about if I sell a call? Well, if I sell a call, I am committing, and some of you may be familiar with selling what they call a covered call. I'm committing, or I'm obligated to sell my shares if requested. Now, if I don't have the shares, I have to go out and buy them. I'm obligated to sell at the strike that we've negotiated at any time up until expiration. If I sell a put, I'm obligated to buy, at the discretion of the buyer, the person on the other side. I'm obligated to buy the shares at the strike negotiated. Now, when I buy a call, what direction, and again, I've got calls and puts over here, and in the interests of time, I'm just going to do B for buy and S for sell. So when I buy a call, what direction, and feel free to type into the chat, how can you sell a put I have a question, how can you sell a put that you don't own? When you sell a put, you are committing to buy the shares if requested at any time between now and expiration. So that tends to be, and we're going to go over this right now actually, so just bear with me. I had a question in the chat. So when I buy a call, the expectation is that the stock is going to go up in price. Through our analysis, whether it's technical or otherwise, we're expecting the stock to go up in price. If I buy a put, I'm expecting that stock value to fall in price. That's the expectation. If I sell a call, I may be expecting it to kind of go a whole lot of nowhere, or I may be expecting it to come down in price. And depending on where I've sold my strike, it may even be able to come up a little bit, and I'd still be okay. So if, for example, on the sold strike, I had, let me just put it in a different color, I had bought a stock and, maybe I didn't really want to sell it, but it was kind of going in this, it was around $95 and it kept going, 93 to 95, 93 to 95. I sell the $100 call because I want to make a little extra income, and maybe I make $2 on that. Well, if it closes at $99, so it can go up $4, I still get to keep my $2, and I also get to keep the stock. Now, could I be called out? I could, but why would somebody want to pay me $100 for a stock they could buy at $99? So this is why I say it could go up a little bit in value. The same on the put side, in that, this is another, when I'm selling a put, I'm agreeing to buy it at a certain price, and if it goes sideways, I still have a profitable trade. If it goes up in value, because this is a bullish strategy, I have a profitable trade. And it can sometimes, depending on where my strike is, even come down a little bit, and I still have a profitable trade. But when I'm selling a put, it's a bullish to neutral strategy. Like buying a call is a bullish strategy. If I'm selling a call, it's a neutral to bearish strategy. And when I sell a put, it's a bearish strategy. Okay, so what are the other two grids about? Okay, risk and reward. In other words, how much money could I possibly lose on this trade? And how much could I possibly make on this trade? Anybody want to know how much money you can make trading options? Most would say, yay, tell me. Okay, so when I buy a call, and I'm going to, just in the interest of time, I'm putting the risk, how much can I lose first, and then how much can I make second. So the most I can lose when I'm buying, and it's actually whether I'm buying a put or a call, the most I can lose is the premium that I've paid to get in. And how much can I make? Well, it's actually unlimited on the call side, because really it could go up to the sky. There is no top to how high a stock could go in value theoretically. Now, although it's not unlimited, many could, use the word huge. But technically, the most that you could lose, you're expecting it, the most you could make, you're expecting it to fall would be if it went all the way to zero. So if you sold something again at this $100 strike, if I bought at the 100 and it did go all the way to zero, then I could make that much a share, the amount of my strike, minus what I paid to get in, minus my premium. So it's a pretty big number. But it's not unlimited. Now, what about if I'm going back to the sell side? Well, when I sell, if I sell a call and I don't own the stock, technically my risk is unlimited. Because what if it did go up by $50 or $100 a share? If I sold that $100 call and it went up to $200, I'd have to go out and buy it at $200 and sell it to you at $100, because when you sell, remember, you are obligated. There's no going, wow, was I ever wrong about that, and walking away. If you have bought a call, you can walk away and go, wow, that didn't go the way I was hoping. When you sell, you're obligated. And how much can you make? The most you can make is the credit, is the amount that you got paid. And it's the same thing when you sell a put. The most you can make is the credit. And again, when I'm selling a put, it's a bullish strategy. So if the trade goes against me and goes down, my risk isn't unlimited, but it's pretty darn big, because again, it's that strike I've sold, plus only, in this instance, it's plus the premium if it went to zero. Okay, so that's risk and reward. We have one last column, and that is time decay. So we've talked about this in some of our individual classes, but we have price, time, and volatility impact the price of options. And I'm not going to talk a lot about volatility today, but know that every day that you're in a trade, when you've bought an option, as it approaches expiration, time is chipping away at its value. So when you buy a put or a call, time is not your friend. And I'm just going to put that as a sad face. But when you're selling, most often the strategy is for you to sell the call or sell the put and have those options expire worthless. So time is definitely your friend. So bring the time decay on. And in the last 20 days or so, time decay starts to increase. So the rate of decay increases. So again, when you're selling, that's a happy event. When you're buying, you have to be very aware of time decay, because even if the price isn't moving, the value of your option can be eaten up by time decay. So I encourage you to practice this. Draw your 4 grids and think about, is time my friend? Which direction do I want the stock to move? If I buy or sell or a put or a call, what does it really mean when I buy a call or a put or sell a call or a put? Do I have the right or the obligation? And is it to buy or is it to sell? And then what is my risk and reward look like? And I know a lot of people or at least some people, when they look at risk and reward and they're going, just a minute, the most I can lose is my premium when I buy, and my reward can potentially be, 1, 2, 300% or 10, 20, 30%, where on the sell side, I'm limited to the credit that I'm paid when I get in. And it makes buying look really appealing. But my friends, you have to keep in mind that typically when you're buying, you've got to be right on direction and time frame within the direction. So if you're buying something that expires in 30 days, it has to move within that time frame. Where when you sell, it can go nowhere and you can still have a successful trade. So there are benefits to both sides. Okay, so now let's come over to Thinkorswim. Okay, so I have brought up NetEase, which is moving currently to the upside. And so if you wanted to practice, you could look at NetEase if you wanted to buy a call. We could also look at a stock called Merck, which has been uptrending. But I thought for today's example, we would go in and look at Skyworks. And again, we could also look at NVIDIA if we wanted to look at buying a put, because we're looking now, when we're buying a call, we're looking for something that's uptrending. When we're buying a put, we're looking for something that's downtrending. So we could look at NVIDIA or SWKS, Skyworks. And so those, if you want to practice, those are ones that you might want to consider just practicing in paperMoney. So if we look at Skyworks and say, okay, when we look at this recently, we're seeing that we had a high, we had a lower and a low, then we had a lower high, it had a one-day rally, lower low, came back up to kind of a similar high, lower low. So, and again, we're just using this as an example to practice today. So if we come over to, our trade tab, and we look at Skyworks, and guys, the trade tab can be intimidating with respect to options when you first come in. However, what I want you to do is just focus on that section that you really need. So first of all, you're going to want to come over and make sure, do I have the right ticker symbol? Yep, I've got Skyworks. Many, or at least some coaches will come and they'll say, some investors will come over and they want to see this number be in the $1 million plus range. So we're at 977,000 today. They're also going to want to come, and when they look at expiration dates, so when we come to the trade tab, we have the call side and the put side. So if we're going to buy a put, we really aren't even going to look at the call side. We're going to look over here for expiration dates. So we have options expiring today. The ones in black, you'll see December 21st is in black. That's because it's a monthly. The ones in purple are weeklies. So if we say, well, if we wanted to do something in the 20 to 50 day range, we could come out to the next monthly, the 18th of January, 35 days to expiration. The 100 means that every option we buy represents 100 shares. And it also means that when we look at the price of our option, so if we were to look at the January 18th, and you'll see this, our expiration date is repeated down the middle, and then our strikes are listed here. we'll see that the 67.50, it's called the at the money strike. So it's not in the money as the $70 strike is. It's the first strike out of the money. And this is called the at the money strike. So we can see that we have open interest of 521 contracts, which means that's how many contracts are on the books currently between the buyers and the sellers. And we can see that one person, we have one contract that has traded hands today. So if we buy a put, we'd be contract number 2. Now, this is delta, and delta tells us the probability of this stock being at our strike price or below on expiration. And it says you've got a 40% chance of this strike being in the money on expiration. So if we wanted to buy this put, I'm just going to get rid of my markings. I'm going to come out, right click, buy, single, and if we do one contract, at $2.35, confirm and send. What's the most we can lose on this trade? $2.35 a share, or $235. I'm just doing one contract. I have a question. Why are we doing only one contract? Just to make the math easier. If you were willing to risk $1,000 on a trade, you might do 4 contracts. If you put a stop in at a 50% loss, you might be willing to do 8 contracts. But just to keep it easy and so we can see how the math works out, the most we can lose on this trade is $235. The most we can make is $6,515. Well, where did that number come from? It came from the $67.50, which is the strike that we've traded, and we're subtracting the $235 that we're paying to get into the trade. So that comes out to $65.15, and then we're multiplying that by 100. So I'm going to get rid of that, and we're going to go ahead and send that in, and we're just going to do the one contract. But as someone mentioned, you know what, so we're going to send that in, and it got filled right away. Now if we come back to the chart, so what are we looking for here? Our expectation, this is below the 30-day moving average. It's bouncing down off the 10-day moving. So this is a 30-period moving average. How do I know that? Because it says up here that that red line is a 30-day simple, and the blue line is the 10. So the expectation is that this is going to continue to move to the downside. And in order to be successful, our strike is here at 67.50. It needs to move below 67.50 ultimately for that trade to be profitable. Now again, price is one component. The time decay and volatility can impact the value of this option also. If it continues to fall, generally as prices fall, volatility will go up, and that will inflate the price of your option. So that will be a good thing because you've bought this option, and your anticipation is that the value of the option will go up as the price of the stock falls. If this just hangs out and goes nowhere, theta will start chipping away at the value, and you will not have a profitable trade. If it goes up in value, this trade will not be profitable. So guys, half an hour comes and goes so very quickly. Next week, we're back to long calls. So we'll be doing long calls next week. We'll be talking about, which is buying a call. So we'll be talking about that next week. If you're interested in learning more about a particular strategy like selling puts, you can go to the archives and look at short puts, and there will be a half-hour session archived in here on that. I hope you found those 4 grids helpful. If you like that concept, I would love it if you just type a little something into the chat. And on that, we're going to come back to our PowerPoint. I had, we've got Greeks, delta, gamma, vega, theta, again, based on price, time, volatility and time decay. Oh, maybe I should get rid of these. Oops. Sorry, I don't know how I did that. There we go. Just to go back to our disclosures one last time, please know that all trading has risks. Please know also that although we looked at a couple of different symbols, in order to demonstrate the functionality of the platform, TD Ameritrade does not make any recommendations for you in your own personal account. Any investment decision you make is your personal responsibility. And although I've put these grids in here, we did draw through them. So we've got direction, we've got max loss, max gain, and again, although under the put side it says infinite, it really isn't infinite. It's huge but not infinite. Time is your friend when you're selling, not your friend when you're buying. And up next, we've got Cameron May with the Options Week in Review. Great guy, awesome coach, always lots of great news you can use. It's our last live broadcast of the day. Hope you can take advantage of it, my friends. Thank you so much for being with me. Thank you for investing in your financial future by investing the time to be part of this call. Love participating with each and every one of you. Have a great weekend. I'll see you soon. Thank you.